welcome to Iron Financial. I'm your lead analyst, and my mission today, as it is every single day, is to help you absolutely cut through the deafening market noise, eliminate the weakness in your holdings, and forge a significantly stronger portfolio. Look, we don't do hype here. We just don't. We look at the raw materials, the structural integrity of the balance sheets, and the cold hard numbers that actually drive the market. If you want to build a portfolio that can actually withstand market earthquakes and navigate the brutal, high-stakes war of the AI sector, you've got to hit that subscribe button right now. Joining me as always is our market skeptic, who is sitting right in the chair of you, the audience, ready to ask the tough questions. We are tearing into Oracle's Q4 fiscal 2026 earnings today, and I got to tell you, the stakes for the broader AI market have literally never been higher. So, is this momentum real, or is this just another market illusion waiting to trap your capital?
Thanks for having me back. And man, today we really do have a massive paradox on our hands. On paper, Oracle's earnings report looks like an absolute powerhouse performance. The numbers they are throwing around are just staggering, but the actual market reaction, it tells a completely different, incredibly volatile story.
Let's talk about this massive contradiction. Seriously, how in the world can a company print record money? We are talking about an astonishing $19.2 billion in revenue in a single 3-month quarter, while the market simultaneously cracks the foundation of its stock price, sending it down over 7% in after-hours trading. For a mega-cap company the size of Oracle, a 7% drop is not just a bad day at the office. That represents tens of billions of dollars in market capitalization completely wiped out in the blink of an eye. If you are sitting at home holding this stock, you desperately need to understand, is this just an extreme overreaction by skittish, panicky traders, or are institutional investors seeing a fatal, unfixable flaw in Oracle's blueprints? Right, let's dive into exactly that. That 7% drop represents billions of dollars in market cap wiped out in an instant. Yes, no one is denying that. But to understand if that's a structural failure or a very rare buying opportunity for your portfolio, we have to look past the surface-level panic. We've got to drill down into the core financials and see what is actually holding this massive company up. We need to measure the thickness of the steel.
Let's start by looking at this solid foundation. The raw numbers from Oracle's Q4 financial highlights are telling a very specific story. We're seeing a 21% top-line revenue growth, pushing them to that $19.2 billion. But what this actually means for your portfolio is hidden deeper in the profitability metrics. Non-GAAP operating income hit an impressive $8.6 billion. That is up 22%.
I'll validate that for sure. A 21% top-line growth for a legacy tech giant is nothing to sneeze at. That requires some incredibly heavy lifting on their part.
Absolutely. And more importantly, notice that the operating income grew at 22%, which means it's growing faster than the 21% revenue growth. That tells us they are experiencing real margin expansion. The core business is highly profitable before you even start to factor in any complex accounting tricks. They're generating massive, undeniable amounts of capital right now.
Sure, but revenue is just one part of the equation. Where's this growth actually coming from? Because if it's just their old legacy database business clinging to life by squeezing existing customers for higher fees, well, that foundation isn't going to hold up the future.
That's a fair point, but the structural shift in Oracle's entire business model is staggering, and it entirely answers that exact question. Cloud revenue is now sitting at $9.9 billion for the quarter. That is up a massive 47% year over year. It has completely eclipsed their traditional software business, which is sitting at $6.8 billion and is actually down 2%. They are successfully transitioning the entire weight of this massive enterprise straight into the cloud.
Okay, so they've successfully transitioned from on-premise legacy software to the cloud. They aren't just selling licenses on a CD-ROM anymore. They're selling the infrastructure over the internet. Got it. But the cloud market is dominated by absolute behemoths. You've got Amazon Web Services, Microsoft Azure, Google Cloud. These companies have a massive head start and literally unlimited war chests. How is Oracle possibly carving out enough space in that entrenched oligopoly to justify these current sky-high valuations?
They are doing it by absolutely crushing the infrastructure game. I'm dropping this massive number like an anvil right now, 93%. That is Oracle's year-over-year growth in cloud infrastructure, or IaaS, bringing in $5.8 billion in Q4 alone. They completely blew past the already high market expectations of 91%.
For those who might be newer to the tech sector, let's quickly define that. IaaS, or infrastructure as a service, isn't just a piece of software you log into.
Right, exactly. It is the raw, heavy-duty computing power, it's the physical server space, the intricate networking, and the massive, power-hungry GPU clusters required to train complex generative AI models. Oracle is out there aggressively building out data centers and securing massive contracts for these exact AI workloads, positioning themselves as a premier builder in the space. They are laying the concrete.
Well, 93% growth is staggering, I'll definitely give you that. But infrastructure is a brutal, low-margin war of attrition. You have to spend billions and billions just to keep the lights on and stay in the game with Amazon and Microsoft. What about the high-margin stuff? Is their application business just dead weight at this point?
Seriously, we need to look at the application side and see how this builds out the rest of the picture. Because flashy infrastructure numbers are great for the press releases and headlines, but if the core software business is bleeding out, the whole structure eventually collapses under its own weight.
The core is incredibly solid, though. Cloud Applications, which is the SaaS or software as a service side of the house, pulled in $4.1 billion. That represents a very healthy 10% growth. This is being driven by heavy hitters like Fusion Cloud ERP and NetSuite, which are aggressively integrating new agentic AI features.
Wait, agentic AI? What exactly is that?
It's the next evolution. This is AI that doesn't just sit there waiting for a human prompt to answer a question. Agentic AI actively executes complex business tasks autonomously. They aren't just hosting data anymore, they are providing the active AI-driven analytics that massive enterprise companies use to run their entire global operations. This application business provides the high-margin stability that perfectly balances out those heavy infrastructure construction costs.
But if you want to talk about true structural integrity, you have to look at this number. $638 billion. This is Oracle's total remaining performance obligations, or RPO. It is up a mind-bending 363% year over year. It grew by $85 billion sequentially from just the previous quarter alone. To put that into perspective, $638 billion is roughly the entire gross domestic product of a country like Argentina or Sweden, and it's just locked in as future revenue for Oracle.
Wait a second. So this is contracted future revenue. This is money that is legally guaranteed to come in over the next few years?
Exactly. This is the ironclad reinforcement securing Oracle's future. It proves beyond a shadow of a doubt that the AI demand isn't just a flash in the pan. It's locked in by multi-year, multi-billion-dollar contracts from major clients who desperately need Oracle's AI cloud capacity, and they're willing to sign on the dotted line today to guarantee it.
Okay, hold on. You've shown me the record revenue, you've shown me the massive multi-billion-dollar backlog. But it's time to talk about the real cracks in the armor. I want to aggressively shift this narrative right now because we are ignoring the massive elephant in the room. You can't forge iron without fire, sure, but building these massive AI data centers requires an unimaginable amount of capital. We need to talk about the terrifying cash burn. Oracle's total capital expenditures for the full year hit $55.7 billion. Free cash flow is negative $23.7 billion for the fiscal year.
Negative free cash flow is a hard metric to look at, I'll give you that.
It's terrifying to Wall Street. What this means for your portfolio is that Oracle has more money going out the door to lay concrete, buy servers, and secure land that is actually coming in from their daily operations. They are burning cash at a truly astonishing rate.
Market Skeptic. Notice the sheer scale of the heavy lifting required here. The net cash outlay for CapEx in FY2026 was $48 billion. But look at the projection for FY2027. It balloons to an expected $70 billion. How can any company, even one as massive as Oracle, sustain that level of outward cash flow without entirely collapsing its own profit margins? You're looking at the raw cost, but you need to look at the massive asset being constructed. Oracle is pursuing unprecedented opportunities in AI cloud infrastructure. AI data centers aren't like the old cloud storage warehouses of 5 years ago. They require entirely new, hyper-expensive architecture. Massive dedicated power grids, advanced liquid cooling systems, and tens of thousands of premium GPUs. They are literally building the physical foundation for the next decade of enterprise computing. You simply do not get 93% IS growth without laying down the physical hardware first.
But they missed their own internal estimates. The previous FY26 CapEx guidance was $50 billion. The actual came in at $55.7 billion. That is a $5.7 billion miss. And this right here is exactly why the market psychology broke down. When management misses a spending target by nearly $6 billion, investors don't see growth, they see a runaway train. They see a complete loss of internal cost controls. That is exactly why the market got spooked and dumped the stock 7%. They are terrified that Oracle is blindly throwing money into a furnace in a desperate, panicked race to catch up with Amazon and Microsoft.
And honestly, it gets worse. To pay for all of this aggressive construction, look at how they are actually financing the future. The company explicitly states they expect to raise approximately $40 billion in the capital markets for FY27 through a combination of debt and equity, and that includes a $20 billion at-the-market equity issuance. For the viewers at home, an at-the-market equity issuance means the company is essentially printing new shares out of thin air and selling them to the public, actively diluting the value of the stock you currently hold in your portfolio. They already raised $43 billion in debt in FY26. Will this massive debt load and shareholder dilution buckle the company's structural integrity? Are they leveraging themselves into a very dangerous corner?
And that right there is exactly the market noise we are here to cut through. Let's look at how they are actually funding this, because it is absolutely not what Wall Street panicked and thought it was.
I want everyone to pay very close attention to this direct quote from their earnings release. This changes everything. The prepaid and customer-supplied hardware portions of our large AI contracts now total $75 billion. So the absolutely crucial point here is this. Oracle isn't taking on all this construction risk blindly. Customers are literally paying for the GPUs up front.
Wait, so the customers themselves are fronting the cash for the actual hardware build-out?
Exactly. They are buying the massive NVIDIA chip clusters themselves and handing them directly to Oracle to rack, stack, and manage. That $75 billion in prepayments drastically mitigates Oracle's actual financial risk. It substantially reduces the amount of capital Oracle must raise on its own to build out these AI data centers. The market demand is so intensely ferocious right now that enterprise clients are literally willing to fund the construction of the building just to guarantee they get an office inside it.
And we are already seeing this heavy CapEx lifting translate into structurally massive, predictable growth. Just look at the forward guidance for the upcoming quarter, Q1 FY27. They are projecting total revenue growth at a midpoint of roughly 28%. And cloud revenue, it's expected to grow at a staggering 61% midpoint in constant currency. The massive capital investments they made in FY26 are immediately yielding explosive top-line returns. Fine, the top-line revenue is growing rapidly, and they have customer prepayments de-risking a lot of the hardware costs. But top-line revenue doesn't pay dividends to shareholders. If they're still issuing equity and taking on massive debt to service these sprawling data centers, what actually happens to the bottom line? Is this company actually going to make a real profit, or are they just generating revenue to service their own massive debt load?
The profitability is incredibly durable. Oracle confirmed their FY27 total revenue guidance of $90 billion. But more importantly, they raised their non-GAAP EPS, or earnings per share, guidance to $8.05.
Wait, a raised $8.05 per share?
Yes, and if you adjust for the one-time events from FY26, like the highly specific sale of their Ampere chip business, that $8.05 actually represents a massive 18% growth in earnings per share. So despite the $70 billion in expected CapEx, despite the debt servicing, the bottom line profitability remains ironclad. The margins are holding because scale in the cloud ultimately drives massive operating leverage. Once you pour the concrete, build the power grid, and plug in the servers, every new software customer you add to that infrastructure is almost pure profit.
All right, it's time for the final verdict. We've laid out the blueprints for everyone. On one hand, you have an unimaginably massive $638 billion RPO backlog, 93% IaaS growth, and customers practically begging to prepay for data centers. On the other hand, you have a company burning through free cash flow, planning a terrifying $70 billion CapEx year, and preparing to dilute shareholders or take on debt to the tune of $40 billion. So, lead analyst, I ask you, is this a golden opportunity to buy the dip, or is it a catastrophic value trap waiting to crush unsuspecting portfolios?
Here is the iron verdict. Do not let the weakness of after-hours trading shake you out of a structurally sound asset. The 7% post-market drop is a crack in market sentiment. It is not a crack in Oracle's business model. Yes, the $55.7 billion in CapEx is heavy lifting, but the $75 billion in customer prepayments acts as a massive financial counterweight, completely de-risking the massive build-out. They have a $638 billion backlog that completely secures their future revenue, and they are generating $32 billion in operating cash flow. The market panicked over the sticker shock of a $5.7 billion CapEx miss, completely ignoring the undeniable reality that you cannot build the future of artificial intelligence without buying the steel, pouring the concrete, and securing the power grids today. This isn't a trap, it is a remarkably solid structural opportunity for smart investors to capitalize on market weakness and forge a much stronger portfolio.
The numbers certainly point to a fortress being built, but the ultimate question remains for you, the viewer, looking at your own portfolio. In the brutal, high-stakes war for global AI dominance, are you willing to stomach the massive multi-billion-dollar construction costs and stock dilution today for the promise of an unbreakable computing monopoly tomorrow? Let us know what you think in the comments below, and don't forget to subscribe to Iron Financial to keep your portfolio forged in strength. We will see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.